Good morning. Today is Wednesday, May 15th. I'm Joe Terril, president of Terril and Company, private wealth managers headquartered in St. Louis, Missouri. With me today is Russ Phillips and Dave Carter, senior portfolio managers and research analysts. This is another update of our thoughts about the economy, interest rates, inflation, the markets, and otherwise where we believe investments could be going and why we're structured the way we are. It's been a fascinating past couple of months to see, in my opinion, the speculation that is returning to these markets. At a time frame when the Federal Reserve is telling everybody we're tight on credit, I would argue they are absolutely not tight on credit. There's plenty of money out there for people to be speculating on everything from cryptocurrencies to meme stocks, as we've seen in the last couple of days. So one of the things that we want to get across to people is reality. The markets are close to making new, as Wall Street says, we're making record highs, but that's a little misleading as to what's gone on in the last 2.5 years. Russ, I know you've got some figures there about what total returns are in equities for the last 2.5 years, and I think the public doesn't understand that unless they've been smart enough somehow to trade in and out, get out at the high, buy back at the low in the last 2.5 years. Give us the figures of what various averages have returned.
Sure, Joe, thank you. So you are correct. Stocks are nearing all-time highs, actually making new highs in certain indexes, and you do see some of this, call it euphoria, with the meme stocks, GameStop, AMC. When we looked back on it, specifically the indexes going back to 2022, what you realize is that the S&P, going back the last 2.5 years, as you said, basically the S&P is up basically about 10% over 2 years. You go and take the equal weighted S&P, and what you tend to find, Joe, is 3%. So what is that really telling us? Number one, your annualized return being in the S&P over the last 2 years has been actually a little less than short-term treasury rates right now, less than 5%. The equal weighted S&P, 3%, has actually not even achieved the returns of short-term treasuries. So yeah, there's been a lot of volatility. Right now there does seem to be some euphoria with the meme craze, and we've seen what's going on in some commodities, cocoa prices, the swings in that. We know that very well because we own Hershey. But also copper prices as of this morning hitting all-time new highs. So there is a lot of volatility, but for individual clients, as we manage portfolios in a prudent fiduciary manner, rates of return haven't been as good as they seem.
I just want to clarify for people that when you say 10%, you're not talking about an annualized rate of 10% a year. You're talking about 2 years and 4 months cumulative return is 10%, which means if you annualize that, they're making somewhere around 3.5–4%.
Exactly right. So the cumulative 2.5 year number is 10%, but the annualized is 4% for the S&P. If you look at the equal weighted S&P, obviously that and cumulative number is 3%, annualized is down around 2%, so not great.
So the approach of being very cautious about where you're invested and how you're invested, but maybe before we talk some more about that, Dave, you do quite a bit for us in fixed income and the bond market, etc. Let's talk about, before we get into where we think interest rates are headed in the future, what have bond markets returned?
Well, as far as, the aggregate bond index over the last 2 years, it's basically been flat, and that includes your dividend or your interest payment. And our strategy over the last 2 years of remaining short has allowed us to roll up our interest rates as bonds have matured. And right now, we're basically 1 year to 18 months in our duration with our fixed income, with returns, say 5.5%, and we have a big commitment also to treasuries where we're getting 5 3/8, 5.40 for 3 to 6 months with no credit risk and no equity risk. And so we're getting equity-like returns in today's market with no risk, and that's hard to beat right now.
When we put this together, our outlook for stocks is very cautious. You must distinguish between stocks that are strictly momentum plays and the algorithm programs that just continually, if it's going up, buy it, regardless of price. If you get caught when that momentum ends, you will suffer dramatically in losses. But that doesn't mean that we don't like some things. Gold stocks, materials, energy, consumer products. There are some areas of the market out there, some of the manufacturers now, that offer good investments because they're not in momentum. And if you're not in the momentum play, many times your stocks can be bought very reasonably at a good investment price. So we also continue to be in the camp that these interest rates are going to stay at these levels. The market so desperately wants the Fed to cut the Fed funds rate from 5.5 down to 3.5 or 4%. We do not see that happening for the balance of this year. Consequently, the people that have tried to guess the bond market, extended maturities, as Dave just pointed out, they've gone nowhere and they haven't made any money. So overall, it's still a good time to be cautious. When there's as much speculation by the public and by aggressive hedge fund managers as what we see in the markets right now, it's a good time for you to maybe not 100% move to the sidelines, but be careful when that momentum can break, or when the programs of chasing things higher and higher and there's no one left to participate, you can see sharp corrections. We'll be back probably in another 2 to 3 weeks with a video update.